In this video, I'll be running through how to fix your profit and loss export so that you can derive more actionable insights and improve as a financial operator within an e-commerce business. Firstly, why should you even care about this? An accurate P&L is the baseline for decision-making within the business. If you can accurately conceptualize the flow-through of revenue into profit, you can understand the levers that exist to further optimize and grow the business. Note that you can send this video directly to your accountant or bookkeeper, and they'll be able to apply all of the changes that I'm about to run through. I'm going to run through 7 common mistakes, and I can guarantee that you're at least making 2 to 3 of them currently within the way that you're reconciling and presenting accounts. Number 1 is a single income line item. This is due to payments hitting your bank account and them simply being reconciled straight away as income. That is not how you want to be reconciling revenue. You want to be able to see gross sales, discounts, taxes, shipping revenue, returns, all the way down to net sales. These are all demand levers that impact the net revenue figure. I'll give you an example of this. So if you look at net revenue in April and then May, and there's a substantial difference, revenue top line, gross revenue might actually be the same. And the only difference between those 2 months was that you heavily discounted in the month after. That's going to significantly impact your cost of goods as a percentage in that month, which is going to flow through to having a substantial impact on net income. In that scenario, if you weren't representing gross sales and discounts and returns and shippings within your P&L, you would not be able to see that. You would not be able to observe it within the P&L, and you therefore would not be able to course correct moving forward and identify why EBITDA was impacted in that particular month. So you have less visibility on what is actually occurring when you're looking at the P&L to derive insights. Number 2 is you want to ensure that marketing isn't looped in with operating expenses and that you're also not doing any grouping here. So starting off with Opex, you want marketing to sit above your operating expenses so that you can generate a contribution profit line item. Rather than just having net revenue, gross margin, and then EBITDA, it's important to have net revenue, gross margin, contribution margin, and then EBITDA. Contribution margin is your gross margin minus direct advertising and marketing expenses. And so this is the amount of contribution profit that needs to be generated to then cover your Opex. Opex should be relatively fixed and stable on a month-on-month basis and should not increase linearly with revenue, as opposed to direct advertising and marketing, which is likely going to increase directly proportional to revenue growth. And so when visualizing and understanding how the P&L is changing over time as the business is scaling, it's really important to not loop marketing and advertising into Opex, because it will look like Opex is increasing proportional to revenue when it in fact isn't. You also want to make sure that there is no grouping. And what I mean by this, and there's a mistake in the P&L that I have screenshotted here, is you don't want it to simply say direct advertising and marketing, and that's it. You want this broken down into Facebook ads, Google ads, influencers, product giveaways, and any other related expense for advertising and marketing so that you can derive further insights into what exact line item pushed through into further demand generation at the top of the P&L or worsened bottom line profit. Number 3, this is so simple, but about 25 to 30% of the clients that we onboard are doing this. They're using cash accounting rather than accrual accounting. Now, why does this matter? Well, at the start of the business, everyone will automatically use cash accounting if you set up your Xero and your accounting software yourself. And the reason being is because it's very easy to do. As you pay for cost of goods, you just reconcile it on that month, on that date, and then that gets cash accounted into that month. There's also some benefits, arguably, if you're a really small business for tax savings, because you're not going to pay tax across the sale period of those products actually getting sold through, and instead you'll deduct off tax immediately when that purchase is made. And so when you're a very small business, you're almost always going to operate on cash accounting because you would have done it yourself, so you wouldn't have known to set it up as accrual. And then number 2 is that there are some tax benefits, and it typically makes sense as well. However, once you're at least a $1 to $2 million business, you need to be moving to accrual accounting there's multiple reasons, but the primary reason that I want to stress in this video is so that you can have accurate monthly gross margins. If you don't know your gross margins month on month, you have no idea what to spend on marketing, you have no idea what you can afford to spend on operating expenses, and then the entire financial operations of the business are in jeopardy. Being a strong financial operator within a business, within an e-com brand, it really does come down to having tight control and understanding of what gross margin, contribution margin, and allocation towards Opex is on a month-on-month basis. And as long as you can have tight control over those levers, you can generally draw more net profit to the bottom line. With cash accounting, like you can see in this screenshot, this is a client that's operating on cash accounting with the numbers slightly changed. You can see that in this month, they did $400,000 in revenue with $270K in cost of goods. And then the next month, they did $1 million in revenue with $156,000 in cost of goods. And so this makes no sense. Why is cost of goods less in this month? And it's because they're using cash accounting. They're directly reconciling these inventory purchases onto the day that the inventory purchase occurs. And now what they've had to do in their accountant, I don't know how they're exactly doing this, but they're doing a line item adjustment month on month to make it seem like gross margin stays relatively stable when it in fact doesn't. There's heavy fluctuations here because of discounts and all kinds of other reasons. And so right now, this is really a meaningless P&L that's not going to provide any insights into how gross margins are changing over time. Number 4, include transaction fees and shipping costs in cost of sale. Majority of gross margin exports, in fact, probably 90% of people watching this video are making this mistake, which is that your gross margin is not your income minus your product cost. That is your product margin. That is not your gross margin. Your gross margin needs to also include the transaction fees and the shipping cost to get the product to the end consumer. I would also want pick and pack and any fulfillment fees associated as well within that cost of sale too, as this is an incurred cost of sale that is variable to revenue. And so it should be included within the cost of sale section within the P&L so that you can get an accurate gross margin figure. Number 5, large ambiguous other buckets. Make sure that they are minimized or don't exist at all. A good rule of thumb here is that if you have over $10,000 of a transaction to a particular line item, that it gets its own category code. A lot of accountants will either take this too far or go in the other direction, which is that they will provide a category code for every single dollar spent on an individual item, which is generally over the top. But then other accountants will really prefer consolidation within the P&L, which can really hurt your ability to know where your dollars are going. I'd much prefer to have excessive detail in the chart of accounts for substantive changes, rather than worrying about just grouping for consolidation's sake. You want to know where your dollars are actually going. Number 6 is percentage visualization for each category. Present your P&L with percentages of net revenue for each category. It's much easier to think about your P&L in this way, rather than try to benchmark and understand the raw numbers. And we can go back to this P&L as an example here, and we're just looking at the very top end of the P&L, and just looking at gross margin, which is inaccurate, and they're not using accrual accounting, and there's all these kinds of issues, but let's ignore all of those and have a look. Looking at these figures, we're going to have to sit here for 10 minutes in itself just to try to figure out what gross margin is doing on a month-on-month basis. Unless you can do incredibly quick math in your head, I don't know if gross margin is improving over the last 6 months. Is it getting worse? It'd be very hard to tell. You'd have to go in and do calculations and divide cost of sales by total income, and then look at how this percentage is changing over time. In comparison, why don't we just have that built into the P&L? And why don't we have that built in at every single level so that we can better cost control in comparison to sales? Okay, we know that operating expenses needs to be maintained at about 12% if we're going to hit this level of revenue. Okay, cool. Can we have that percentage visualized on a month-on-month basis in the P&L so that we know whether we're working towards it or whether we're working away from it and we're going in the wrong direction? As the only way to get that is to manually add it in yourself after the P&L has been sent to you, or to get it into the actual report so that you can get better insights, faster insights, and take action. And the last one is breaking interest payments out from operating expenses. I've seen this in multiple P&Ls now. I didn't think I would have to list this here, but this is being done very commonly. Ensure that interest on loans for inventory is what it particularly is for, is above net income and below EBITDA, so that you have an accurate reflection of the operational capability of the business. If you're looping interest payments into your operating expenses, you are going to get a net income figure, which, yes, shows you the net income of the business, but it doesn't show you the operational capability of the business if you were to exit or if you were to fix the working capital situation within the company and not be reliant on loans. And therefore, a net income and an EBITDA number is really important there. A little side note as well is that interest payments are typically made once a quarter. And so we'll throw the net income statement off substantially every 3 months. And so you won't get a normalized view of what the P&L actually looks like because there's these huge lump sum payments that are coming through that's skewing all the figures. And so you also get a bit of a better normalized view on what the actual results are on a month-on-month basis rather than having that line item in Opex throw everything around. Once again, you're likely making 2 to 3 of these mistakes that I've gone through in this video. To recap, mistake number 1 is a single income line item. Number 2 is ensuring that marketing isn't in Opex so that you have a contribution margin report line and you don't go ahead and group direct marketing and advertising. Make sure that you're using accrual accounting if you're a business over $1 million a year rather than cash accounting so that you have more accurate gross margin figures. Make sure that you're actually getting an accurate gross margin figure by including all of the relevant variable costs associated with delivering a product to the end consumer. Make sure that you don't have large, ambiguous other buckets that are fluctuating by thousands, if not tens of to hundreds of thousands of dollars per month. Number 6 is make sure there's percentage visualization for each category so that you can actually draw actionable insights quite quickly and apply them into the business. And number 7 is break out interest payments from operating expenses so that you can get an accurate reflection of the operational capability of the business.